Welcome to the fourth segment of the Corporate Issuers Masterclass. My name is Darren Lee, and we will continue this time here, in contrast to what we've done before. This learning module and the next two will be much more quantitative in nature. Now in this section, we're going to look at working capital and liquidity. We're going to cover short-term assets and liabilities here. Right? Those are ones that roughly result in cash inflows and outflows during the year. How the asset and liability balances change are mainly dependent on the company's payment and delivery terms with its customers and suppliers. Okay, so we'll look at accounts receivable and accounts payable in that regard. Short-term assets and liabilities are the dominant factor in a company's ability to generate cash flows. That means mismatches between the timing and liquidity of assets and liabilities may potentially have disastrous impacts on a company. So that means it's very important to closely monitor a company's cash conversion cycle and liquidity. So that's sort of a general overview of what we're going to try to get at in this section. Now, going into a little bit more detail, there are three main considerations here for exam purposes, and I'm just going to work through each of these here with you in a little bit of detail. So number one, must know you got to be able to work with the cash conversion cycle. So mechanically speaking, it's computed as the sum of two items, really, I guess. The sum of the days of inventory on hand, and as well as the days of sales outstanding, minus, of course, the days of payables outstanding. Okay, so that's the simple equation here that you have to understand. So interpretively, a short cash conversion cycle is generally desired, and that means, of course, that a company can convert an investment in inventory into cash quite quickly. In contrast, a long cash conversion cycle means that the company converts its inventory investments into cash rather slowly. So given a choice, you'll want a shorter cash conversion cycle, obviously. Okay. Number two gets us into liquidity, right? And liquidity is mainly determined by the relative amounts and liquidity of its short-term assets and liabilities, which are, of course, dictated by the company's business model. So for most companies, the long-term and primary source of liquidity is going to be cash flow from operations. I'll just sort of abbreviate here as CFO. Secondary sources of liquidity are usually drawn upon more in emergency situations, and they can be quite costly. So you want to be able to generate the cash flow from within your operations. Now, third takeaway for the exam here is the working capital. And so companies may utilize a conservative, moderate, or aggressive approach to working capital management. Now, those approaches are going to differ in the amount of working capital held on the balance sheet, as well as in their dependence on external financing, as well as the breakdown between short-term and long-term financing. Okay, so that'll sort of give you now a nice overview of the details that we're going to get into. All right, so we'll start right now into the cash conversion cycle. So the easiest way to think about these two concepts, operating cycle and cash conversion cycle, is that as illustrated in the equation I did earlier, the operating cycle is the subset of the cash conversion cycle. In other words, the operating cycle consists of only the first two parts of the cash conversion cycle, the time involved with manufacturing inventory in this case, and then the time in attempting to collect the cash from credit sales. So you could think of this DOH plus DSO. Okay, and in fact that's indicated right here. So of course I always tell candidates, once you're familiar with the operating cycle, we're going to add one extra element, and that's the DPO item, the payables that are outstanding. And this of course is the part about paying the suppliers. Now since that is a negative item as noted in the equation as DPO, then you must always remember that the operating cycle will almost always be longer than or at least the same as the cash conversion cycle. Now, in this cash conversion cycle numerical example, we just have to perform basic calculations, and then we need to interpret the calculations. Okay, and that's where the explain part comes in. So just remember the two items you add and which item you subtract. Now they're not necessarily presented in the order that they appear, so you've got to read carefully, because the inventory on hand is first, and then the days of sales outstanding, and then you minus out the payables, but it's not presented that way. So be careful and don't rush and read very carefully. Okay, calculating the cash conversion cycle for issuers A, B, and C, I think is quite straightforward, as you can see. Okay, all right. So here are the numbers. Okay, you can see obviously these are pluses, and this one is a minus. Okay, let's look at the interpretation. Right, we look at issuer B. Okay. With the longest cash conversion cycle of the three at 50 days. So the interpretation discussion means that the firm issuer B has to finance their inventory and receivables for a relatively longer time than issuers A and C. And so the need to finance that likely indicates a reliance on external financing. Okay? Next. Looking at these methods here, you don't want to memorize these methods to shorten the cash conversion cycle. Instead, what you want to do is focus on the logic behind them. Okay? So in other words, from a big picture perspective, of course, what you want is you want the lowest days on hand, and you want the lowest sales outstanding, right? Because those will increase the cash conversion cycle. And you want, of course, the highest DPO, because that, of course, will decrease the cash conversion cycle. So this makes for a really good qualitative exam question, as it requires you to understand the cash conversion cycle equation, and it doesn't always require you to do the mechanical calculation, which I think many of you are comfortable doing, but there's also sort of the non-quantitative aspects. Okay, so let's take a good look at each of these separately, okay? The first one, which is, of course, your investment here in inventory, it would make sense, as I said, you want to keep the lowest amount of inventory on hand. So the extreme situation would be the just-in-time method here, where you basically keep no inventory and you order it in as you need it. Or maybe somewhere in the middle here where you do a careful analysis of inventory to optimize or reduce what needs to be kept on hand based on customer demand, right? You want to avoid stockouts, but at the same time you want to carry too much inventory. Okay, so it's kind of a fine balance there. Now let's go to the second one about managing your accounts receivable. Okay, that's what this whole section's about. The investment in AR really boils down to how fast you are collecting your outstanding payments. Now, incentives to pay upfront or pay early before the due date would of course make sense. Or alternatively, you could simply not extend as much credit and insist on more cash or upfront payments. Now, this is obviously more complicated than that, since there is a trade-off of lost potential sales when credit standards are too tight. Okay, so you don't just necessarily want to sort of do a blanket thing and say, well, let's just tighten credit standards, period, because the opportunity cost of that is that, well, even though you have to wait a little longer, you still might generate more sales. So you got to deal with lost sales here, and that's sometimes it's worth it to have the sale even though they might not pay you right away. Now, the last one here we're going to talk about here is your payables management. All right, and there's a little bit of an art to this, right? It's the exact opposite to collecting payments. So the issuer is now not collecting, but it is now paying. So the amount owing is a receivable to the other party. Right? So forgetting about the usual incentives such as early payment discounts as discussed earlier, the general idea here is to delay payment for as long as possible to conserve cash. But obviously you don't want to annoy your supplier either, so it's a little bit of negotiating involved here. Now let's do a numerical analysis of the early payment discounts. This is a very typical exam question. The point here is to calculate the opportunity cost in percentage terms of foregoing the early payment discount. So you can take a shortcut by eyeballing the three choices, and in that regard, seeing that A looks to be the so-called worst deal and B looks to be the best deal. But let's start and do the analysis with A. So this is a 1% discount for making the payment here, 40 days earlier, right? Because it's saying that it would normally be due in 50 days, but you get a 1% discount for paying on day 10. So that's a 40-day difference here. Okay, so if we do the calculation on that. Using this equation, which I guess you will memorize and learn, but eventually it will become second nature. We will see that it comes out to 9.6%. So let's interpret what this means, okay? If you can borrow funds in the external market for less than 9.6%, then do so and pay off the full amount on day 10 instead of day 50. Okay, so let's follow the same parallel analysis for the next choices here. So in this one here, what you have is you have 25 days. Okay, so if we look at B, it's a 2% discount for making payment 25 days earlier. Now, this is clearly better than A, since it is a larger discount at 2% versus 1, and the payment is due in a lower number of days. So if you do the computation on that, the rate comes out to 34.3%, and it's virtually certain that you can borrow funds in this market nowadays for less than 34.3% to pay off the full amount on day 15 instead of day 40. So in other words, another way to interpret this one here, this is the best discount. Okay? Or A is the worst discount. I mean, they're all good in the sense that, you know, you're getting a discount, but it's just the, you know, on a converted annualized percentage basis, which is better. Now let's go over to C here, just for absolute completeness here. This is 45 days, okay? So it's a 3% discount for making payment 45 days earlier. Now, it is clearly better than A, since it is 3 times the discount, but just a similar number of days of speeded up collections. If we do the calculation, it comes out to 28%. So, you know, it's still a pretty good deal, not quite as good as B. All right, so putting this all together and doing this in real slow motion, the lowest rate or the lowest opportunity cost here is A. So stated alternatively, A's discount provisions are the least attractive and B's discount provisions are the most attractive. Since the question asks you for the lowest effective interest rate, then you choose answer A. Okay, so I did a very detailed example here. This is probably sort of the maximum difficulty you should expect to see in a numerical question on an exam, but I think this example is quite comprehensive and sort of covers everything that you need to know about discounts, not just from a computational perspective, but also from an interpretive. Now here we have 2 definitions of working capital to grasp and differentiate. Now total working capital is quite straightforward. This is intuitive and you should already know this. It's the traditional definition of working capital that you should already know. Net working capital, on the other hand, is a little bit more subtle. So if someone was going to test something here, they'd probably test net working capital, see if you really understand it or not. So rather than sitting here and memorizing the exact details, just remember that if you're doing the adjustment here for both current assets and liabilities, check what they are excluding, okay? In both current assets and current liabilities, we are essentially removing the cash-like or the monetary items such as debt. Okay, what remains here are the not so cash-like items such as AR, AP, and inventory. Okay, so it gives you sort of a truer sense of working capital rather than just the short-term assets and liabilities. We're taking out the cash and the debt. Okay, so that's really all I wanted to say on that. Now, when looking at the opportunity cost of capital and the capital allocation decisions, the rule here is to minimize the working capital holdings, right? Because they are generally less productive, okay? And you really want to try to maximize and have more allocation to things like property, plant, and equipment, for example, which are generally more productive and offer a higher return on investment, or ROI. Okay, we'll explore more of that later, but this is just to give you a little taste of it right now here. In this example, I want you to look at the balance sheet summary of all the assets and the liabilities and equity, as we are going to demonstrate a working capital computation in just a moment here. Okay? The question asks for net working capital. Okay? So recall in this case that we need to exclude cash and marketable securities in the current assets, and we need to exclude any debt in the current liabilities. So therefore, for current assets, we're going to take the accounts receivable, inventory, and the prepaid expenses. And for the current liabilities, we're going to take the accounts payable and the accrued expenses. Okay? So netting the two amounts is going to give us the net working capital. And that amount will come out to, of course, with this calculation, 380. So B has to be the correct answer. Now, this discussion of liquidity should be mainly a review of what you already know once again, right? The key to remember is that liquidity refers to anything within 1 year. So assuming the balance sheet date is December 31st, year 1, then the items will be settled prior to the next balance sheet date of December 31st, year 2. Also, with the presentation for current assets, for example, the ordering is based on what is most easily converted to cash. So obviously, in this case, cash is first because it already is cash, but inventory is presented usually last because it's the hardest to convert to cash, or at least it takes the longest. Now, for current liabilities, the ordering is based on what is needing to be paid off the soonest. Okay, so things like payroll, right? I mean, which is, you know, sometimes, I mean, if it's like a 2-week cycle, it might need to be paid in the next few days. Short-term debt is due within the year. It could be any amount of time, not necessarily just a few days from now. Okay? All right, so that's just a couple points on that. Now, moving on, you know, if you look at liquidity and think about working capital management and your role, let's say as the chief financial officer, you would need to be able to come up with primary sources of liquidity to fund a potential temporary or short-term cash shortfall. Now, obviously, you would start with the cash you have plus what you can borrow. And looking deeper and more long-term, you would have to consider the company's cash flow generating power. Okay, and so that's these two items kind of talked about right here. So borrowings, what you can sort of get to more immediately, but cash flow from the business is really what you're kind of thinking about on an ongoing basis. So in this sense, okay, just in this context, we are not using the word liquidity in a very literal sense of the immediate 12 months, but really more to describe long-term solvency over multiple years, especially when we talk about cash flow from the business. I just wanted to just clear up a minor point on terminology. Now, as a starting point, looking at this equation, it's important to note the CFAI definition of cash flow from operations, CFO, as we often abbreviate, appears to be US GAAP and not IFRS. Okay, just as a FYI. Looking at the details, it makes intuitive sense, as one could say cash received from customers loosely corresponds here, to the notion of revenue, and cash paid to employees and suppliers, for instance, this would loosely correspond to cost of goods sold and operating expenses, for example. Okay? To calculate free cash flow, you have to look at the cash flow statement to find out what the investment in long-term assets is. Okay? In other words, what annual cash flow needs to be maintained and possibly used to expand the capital asset base. Now, assuming this was a forecast into the future, historical depreciation expense with possible adjustments is often used as a proxy for investment in long-term assets, or the amount could be separately forecasted using the best available information possessed by management, for example. Now for us to calculate free cash flow, which is a relatively straightforward two-step calculation. Now, as we recall, the starting point for the calculation using this data should be 1,400, the cash flow from operations. And from there, we are going to deduct the investment in long-term assets of 800. So that should get you to 600, and the correct answer in this case would be B. There's a much wider range of possibilities when we consider secondary sources of liquidity. So let's go through most of these here. The first one here is pretty straightforward about dividends. That's just saving on cash flow. So I'm going to start with the second one here. As an example, deferring or lowering capital spending could work, but of course that comes here at a trade-off. Right? And the trade-off is, of course, possible lost investment opportunities and reduced long-term value. Now, we could also consider issuing equity, but of course, again, there's also a trade-off here. The trade-off here is the issue here of ownership dilution for the shareholders, right? Now, we've seen this in recent examples in real life, such as Lufthansa Airlines raising 600 million euro through a convertible bond offering, right? So as you know, convertible bonds could convert to equity, and that's where the dilution risk comes in. Singapore Airlines raised the equivalent of 8.8 billion in their currency via a rights issue. Well, a rights issue here, of course, is equity related here. Renegotiating contract terms, of course, is for debt financing, maybe, for instance, to lengthen the repayment terms to reduce the periodic payments, or requesting relief on interest and lease obligations. Selling assets is also possible. Of course, the focus here, you'd want to be selling non-essential or redundant assets. So these would be things like marketable securities or real estate not used in the business, or an unimportant, peripheral subsidiary. When calculating net cash flows, of course, one little point is ensure that you deduct any liquidation costs. Last point here, of course, is to file for bankruptcy protection. This is not bankruptcy per se. It is to allow time to reorganize and restructure operations to generate cash and increase future profitability. So the key word here is that the company intends to remain a going concern. A going concern, of course, is a good thing. A going concern means that they're going to continue business as usual, but it just requires a little bit of a reprieve here to allow them to restructure their business. Let's take a look here now. First slide, drag on liquidity. Okay, so really in short, drags on liquidity are bad. Okay, which sort of means here that your inflows of cash are not coming in as you expect them to. Okay, so I'm going to briefly describe 3 examples that impair cash inflows. So we'll start with uncollected receivables. Okay, so the longer the days of receivables outstanding, the less likely they will be collected. No. Okay, so the stricter credit and collection policies may mitigate the risk, but once again, they may also result in lost sales. So again, there's sort of a fine line in determining how strict you want your credit policy to be in terms of generating sales versus bad debts here. Obsolete inventory is pretty obvious. It refers to items that are not demanded by customers and can only be liquidated at a discounted amount, right? So the thing is that the amount and the timing of the cash flows, which is low amount and later, are both unfavorable. Okay, borrowing constraints refer to banker or lender imposed, right? Constraints, and this could be, an increased cost and or decreased availability of short-term debt. So if the interest rate becomes prohibitively high, well, then you can't borrow. Right, or if they're not willing to extend credit, that becomes a liquidity constraint. On the other hand, a pull on liquidity is also bad because now we're looking at outflows. So whereas before we're looking at slowed down inflows, we're now looking at speeded up outflows. Okay, so that's also not good, right? So I'm going to have us look at 4 examples that cause cash outflows to be greater or accelerated. So the first one is obvious here about making early payments, and I just raised the issue here of discounts. Now, unless there is a financial benefit in doing so, such as the early payment discounts that we discussed earlier, don't make early payments. Like, make it right on time and maximize your cash flow for as long as possible. Secondly, suppliers may lower or eliminate credit limits for companies that have weak repayment history. Okay, so they just kind of say, okay, we're clamping down on you now, and we're not going to extend as much credit here. The bank, as I said, may lower or eliminate credit limits to some companies, thereby potentially causing liquidity constraints. Okay, so again, there's some similarities here between this slide and the previous one. Also, in this last point, in a deliberate fashion, some companies have weak liquidity positions because they engage in aggressive working capital management here. Policies, right? So, not working capital, WC here, management techniques here. They try deliberately to maintain minimal cash balances to avoid cash drag, for instance. All right, let's take a look here at examples of drags and pulls on liquidity and analyze these three trends. Okay, now I'm going to take a look at each of these separately. The increase in DSO here would be an example of uncollected receivables, and therefore this would be a drag on liquidity. Okay, the increase in days of inventory on hand could be an example of obsolete inventory, and this would also be a drag on liquidity. Now, the last one is an increase in credit limits by lenders. Now, this is not a pull on liquidity. A pull on liquidity would be lowered credit limits. So an increase in credit limits here actually helps liquidity. So if you look and the question says, which trend does not contribute to liquidity challenge? In other words, which one of these things doesn't worsen the liquidity? Well, that should be pretty obvious now, right? It's like the increase in credit limits is the one that is helping the liquidity situation, not worsening it. So, as a result here, C is the better and best answer. It's not contributing to the liquidity challenge, and therefore it is the correct answer. So you just got to work with the negative here. Now we're just going to complete our coverage of liquidity by looking at the three relevant ratios that you should be able to compute. And so they're going to go in descending order because the quick current ratio is going to be the largest, the quick ratio is going to be a bit smaller, and the cash ratio will be the absolute smallest one. Okay, now you already know the current ratio, but the other two may require a little bit of review. So in short, just remember that these two sources, or these two equations, measures of liquidity here, are more conservative. Okay, they're stricter measures of liquidity and attempt to remove some of the arguably less liquid current assets, such as inventory. Now, in all cases here, current liabilities are unchanged. Let's look at this comparative balance sheet to use in our subsequent liquidity calculations and interpretation. So we're going to start off with the net working capital calculation for the each of the years, and then we'll do the interpretation. Now, recall that it's going to omit all cash or cash-like items in current assets and all debt items in current liabilities. Okay, so the first thing you should note are what are the items that are included. So we've got three items in current assets, right? And we've got two items in current liabilities. So first of all, understand why we eliminated the ones that we did from the balance sheet. Okay, so these these did not make it, for example. Okay. All right. All right, so continuing on here. Left with these items here, let's go and calculate the amounts, which are pretty straightforward. Okay, so here we go for the year one, right? The pluses and then the minuses gets us net working capital of 16. The pluses and minuses in year two give us a net working capital of 65. So what we need to do is we need to interpret this increase of 49. Now, I think it should be quite clear that much of it is coming from the sharp increase in investment of inventory between the 2 years. Okay, and you can see that right there. Okay, that's it. Right? There's a limited scope in what they can ask you in a 1.5 minute, multiple choice question that you would see on an exam. Now we're going to extend the analysis to 2 of the common liquidity ratios. So that's going to be the current and the quick ratio. The formulas are clearly spelled out here just to remind you, right? And with the current ratio, let's go and do the calculations. We're going to see here an increase in liquidity, right? You can see how it increases from 1.36 to 1.52. But if you look at the quick ratio here, you'll see that it has actually decreased. Okay, so that's a minus, that's a plus. So what's going on, right? These are conflicting conclusions, so we need to understand why. Now, in thinking this through, okay, it is clear that the quick ratio is more relevant since it eliminates the relatively illiquid asset of inventory. So in this case, we override the conclusion made for the current ratio, and instead we're going to look at the quick ratio conclusion instead, and we're going to see that there's a decrease in liquidity. Now, to conclude our study of working capital and liquidity, we're going to explore the 3 approaches to working capital management. So big picture here, there's 3. We're going to start with conservative, then we're going to go to moderate or medium, and then we're going to go to aggressive. So here's the first one here, okay? And actually, I think we're going to do them in contrast. To contrast, I'm going to go conservative and then aggressive, and then go in the middle on moderate here. So I think here a scenario description may be provided to you on an exam, and then you could be asked to select which of the 3 approaches is most applicable, A, B, C. So this makes for a really good multiple choice question. So I think with the conservative approach, if you take a look at the information here on the slide, there's a very ample working capital balance. Likely with a good amount of cash or marketable securities. So because by nature it's conservative, I'm not going to be worried here about short-term liquidity. So no problem with short-term liquidity, right? And that makes sense since we're taking a conservative approach. So no questions on that. Now, a lot of the liquidity is likely financed by long-term borrowings here. But, as a startup company, there may be no other choice if a company cannot obtain short-term financing. Okay? just keep that in mind here. All right, that's the conservative approach. Now let's go and contrast this to the aggressive approach. Okay, so I'll just label that number 2 here. So the aggressive approach is, as I sort of indicated earlier, there's a huge desire to avoid cash drag. So I mentioned before that employing an aggressive approach tries to maximize profitability, especially if there's detailed and reliable information to forecast the cash needs. But it just means that you're keeping a much lower cash balance. Now, to meet the current liabilities, there is extensive use of short-term debt. So the assumption is that the short-term interest rates are quite low. The very small working capital balances assume that inventory holding periods are very short, so they either use the just-in-time system or they know they can get rid of inventory quite quickly. Okay, so this would depend on the nature of the business. Now, for accounts receivable, there may be purchase discounts offered, or credit standards have been set very high so that there are few delinquent customers. Okay, so a lot of this is engineered and designed to collect very quickly and not maintain a very high working capital balance. And then last but not least, we have our moderate approach here. And this is, of course, somewhere in between. Now, cash forecasting ability here perhaps is not as razor sharp or as good as the aggressive approach. For the aggressive approach, you really have to be able to forecast quite accurately. But the accuracy here is still pretty good. And there's a good mix in the use of long-term and short-term debt. Okay, so these last 3 slides here are really just having an understanding and knowledge of the 3 approaches. Now, let's do a little application exercise. It's a very simple exercise in distinguishing between the 2 more extreme working capital management approaches, conservative versus aggressive. Okay, so if you look at this, I think the first 4 items, it is quite clear that they relate to the conservative approach. Okay, with the maximization of working capital balances here with the first, third, and fourth items. Now, the reliance on long-term financing is characteristic of the conservative approach. So, in contrast, if I can just point this as long-term, not short-term. So in contrast, we're going to see that reliance on short-term loans or financing is characteristic of the aggressive approach. Now, finally, let's do a last example on short-term funding needs. Now, if there are more sales, then it means there will be more inventory and therefore more accounts receivable needed to support those sales. Okay, now I know this is 5 answer choices and you only get 3 on the real exam, but just that's okay. Just bear with me here. Okay, so what we're saying about the AR is that is going to, of course, eliminate choices A and E, right? There will be more, there will be more inventory and more AR needed to support the sales. Okay, getting rid of A and E, and there's not enough information to select B, so we're not going to pick that. And then also choice D is completely irrelevant. Okay, so you could sort of then pick here choice C, that there is an increased need for working capital, which would be the inventory and accounts receivable, and C makes sense as the best answer.